Managing cash flow starts with understanding that cash is simply the real money moving in and out of your small business every single day. It is different from profit because profit is an accounting measurement, while cash flow is about actual liquidity in your bank account. Many small business owners get confused when they see profit on paper but still have no money to pay rent or salaries, and that happens because cash flow focuses on timing. A business survives only when it has enough cash to cover upcoming expenses, so cash flow becomes the #1 survival tool for small companies, especially during slow periods or recessions. There are 3 types of cash flow to understand: operating cash flow from day-to-day business activity, investing cash flow from buying or selling equipment or assets, and financing cash flow from loans, investors, or owner contributions. Once you know what type of cash is moving, you also need to understand cash inflows, which include payments from customers, deposits, loans, grants, or refunds, and cash outflows, which include payroll, rent, suppliers, taxes, inventory, marketing, utilities, software subscriptions, and any other money leaving the business. Tracking these inflows and outflows daily gives you real control because small leaks add up when ignored. Even a basic spreadsheet or accounting app can show trends and prevent surprises. The most useful tool to learn is the cash flow statement, which shows how much cash came from operations, how much was spent on assets, and how much came from financing. This statement reveals if the business generated real cash or just paper profit. The timing of payments then becomes extremely important. If you pay suppliers quickly, but your customers take weeks or months to pay you, your cash flow will suffer even if sales look strong. Late customer payments are dangerous because every delayed invoice becomes an interest-free loan that you unintentionally give to the customer, which forces you to borrow money or use credit just to cover bills. Setting clear invoice terms, offering online payment options, and following up regularly are simple tactics that reduce delays and keep cash healthier. Once you understand how late customer payments damage your cash position, you also need to recognize how delaying supplier payments affects your business. Stretching supplier payments can temporarily improve cash flow, but it can damage trust, slow down deliveries, raise prices, or freeze your account with that vendor, so it must be handled carefully and with communication. A healthier approach is to negotiate better terms instead of silently delaying. Invoice terms like net 15, net 30, or net 60 define how long customers have to pay, and choosing the wrong terms can make your business constantly chase cash. Some industries can comfortably run on net 30, while others need faster options like net 10 or due on receipt. Early payment discounts, such as 2% if paid within 10 days, otherwise due in 30 days, reward customers for paying faster, improving your cash position even if you lose a tiny percentage of revenue. Another powerful tactic is asking customers for deposits or milestone-based billing instead of waiting until the end of a project. This is common in construction, design, software development, and consulting because it reduces risk and funds the project while you work. Equally important is separating personal and business finances so cash flow can be measured accurately. Mixing them causes confusion in taxes, bookkeeping, and financial decisions, making it difficult to track whether the business is healthy. Understanding the difference between fixed and variable expenses also matters because fixed expenses like rent and salaries remain constant, while variable expenses like materials, transaction fees, or commissions change with sales volume. Seasonal patterns can create positive or negative cash swings, so businesses in tourism, retail, or agriculture need extra planning and reserves during off-seasons. Forecasting cash flow is the next major skill, and it simply means predicting how much cash will come in and go out in the next few weeks or months. Many business owners are afraid of forecasting because it sounds complicated, but forecasting is often just listing expected revenue, expected expenses, and expected timing. Monthly cash flow projections combine these ideas by helping you see future shortages before they happen. If the projection shows that the business might run short in week 3, you still have time to collect invoices, adjust spending, delay non-essential purchases, or arrange financing before stress hits. Another key idea in cash flow management is working capital, which represents the money a business needs to run day-to-day operations. It is calculated by subtracting current liabilities from current assets, and when working capital is tight, even profitable businesses can struggle to pay bills on time. Inventory plays a major role here because buying too much inventory traps cash on shelves, while buying too little causes stockouts and lost revenue. A healthy inventory turnover ratio means products move fast enough to generate consistent cash instead of sitting and collecting dust. Overbuying inventory is one of the most common cash flow mistakes made by small retailers, restaurants, and e-commerce sellers, especially when they chase bulk discounts that don't actually improve cash flow. On the other hand, subscription expenses and auto-renew services drain cash quietly every month. Many businesses sign up for software, tools, and memberships that are rarely used, and these small monthly charges add up to large yearly expenses that steal cash without providing value. Cutting these unnecessary expenses is one of the easiest ways to improve cash flow without hurting operations. Negotiating with vendors and service providers is another overlooked strategy. You can often ask for better pricing, longer payment terms, or discounts for annual billing if the business has predictable cash. Using simple cash flow tracking software also helps you stay organized. Tools like QuickBooks, Xero, Wave, or Zoho automatically connect to bank accounts and categorize transactions, saving hours of manual work. Finally, bank reconciliation is a habit that small business owners should build. Reconciling means matching your books to your bank statements, so you can catch errors, duplicates, fees, or unexpected charges. Good reconciliation ensures that decisions are made based on real numbers, not just estimates or assumptions. If your business is making sales but not growing the way it should, watch this video. I'm breaking down 5 real finance habits that highly profitable business owners practice every week. Most small business owners skip these basics and lose profit without even realizing it. If you want to build a stable and profitable business, hit play and learn the habits that actually move the needle. If you found this video helpful, then like, share, and subscribe this channel to get future videos. Thank you for watching this video.